Myers. I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Amy Pham, the portfolio manager of the Pengana High Conviction Property Securities Fund. As with the other webinars that we've done in the series, I've asked Amy to keep her prepared section reasonably short, so we'll have plenty of time for Q&A at the end. So any questions that you have about the fund, the environment, or specific exposures, please enter them into the Q&A box, which can be accessed from the icon on your screen, and hopefully we can have a really interesting conversation at the end. Amy is having a little bit of computer problems this morning, so we'll be controlling the slides for her. Amy, over to you.
Good morning, everyone. So let me start with slide 4. For those of you that's not familiar with the fund, there's 3 of us in the team, myself, Jade Ong and Sam Craig. We invest predominantly in Australian real estate investment trusts known as AREITS, and our main objective is to provide capital security, income yield, and sustainable growth. Turning to the next slide. So we do this by adopting a high conviction fund with focus on ESG and secular trend. Being high conviction means that we have a concentrated portfolio, we hold a maximum of 20 stocks, and we pick the best of breed. But more importantly, we look at opportunities outside of the index. Now, ESG is incorporated directly into our valuation ranking and is used to manage risk. We do the work ourselves. We send out ESG questionnaire to all of our REITs that's in our universe, and we use it to rank in terms of the E and S and G. Now, ESG factors makes up about 30% of our valuation. So it is quite significant, and it's not there just, in terms of ticking boxes exercise or a feel good thing. It does impact on our valuation at the end of the day. We also identify emerging markets that are driven by secular trends in order to provide the portfolio with further diversification and sustainable earnings. Over to slide 6. Now, when I talk about emerging markets, these are the types of assets that we look at. It includes childcare, manufactured housing, data centers. Not all of these assets are driven by secular trends with very large addressable markets. For example, when you look at the manufactured housing, we look at the data and 93% of people over 65 years of age is still living in the family home. And within that, the manufactured homes estate market has only got 2% of the market share. So we think that with the cost of living at the moment, affordability, and the lack of housing, we think that the manufactured housing will have a significant growth going forward. Now, in the Australian market, we're a bit behind when we compare that to more matured markets like in the US and the UK, where these alternative assets actually make up more than 60% of their index. Currently, our index has about 8% that's in alternative assets, and when you compare this with our fund, we have more than 24% in our portfolio. Turning to the outlook on slide 7, we think that we expect market volatility to increase due to the geopolitical tensions and rising interest rates. And in this environment, when you look at past performances, REITs, due to its defensive nature, tend to outperform equities in these periods. Looking at both the cash rates and 10-year bonds, which is quite topical at the moment, we expect this to rise, but we think that the majority of it is already factored into market pricing. And then, with the 2 rate hikes from the RBA this month and last month of 25 basis points instead of the 50 basis points that the market has anticipated, signal to us that the RBA is willing to slow down the rate hike. And as the bond rate sort of stabilizes from here, we think that REITs will recover and perform relatively well. And you've seen this in the performance, in October's performance, where the REIT market was up 10%. We think that GDP growth is still quite strong for this year at about 3.25%, and that's mainly due to a lot of it is recovery from COVID. But going forward, with the increase in costs of living and the impact of rising interest rates on mortgages, we think that this will start to have an impact on household consumption, similar to what we've seen in the States. In terms of valuations, it really depends on the asset classes. We think that for office, because of its sort of poor operating environment, even before COVID, where incentive levels are at the 30 to 40%, and then on top of that you've got like high vacancy rates of about 10 to 15% in Sydney and Melbourne. We think that that the operating environment for office is quite low, and with that we have anticipated that the cap rate expansion of 50 basis points for office. For retail, we think that there's a strong recovery in sales post-COVID, but going forward, with the cost of inflation, with the pressure of high energy costs, we think that this will start to weigh on consumption. And then on industrial, we anticipated that the cap rate expansion of 50 basis points, only because industrials has started off with a very low cap rate of about 4% cap rates, and then but however, we think that valuations is going to be maintained, as it is offset by very strong rental growth. In Sydney, we're getting rental growth of 20%, and in Melbourne, we're getting rental growth of about 15% for industrials. And then EPS growth, we think that it's going to be maintained over the long term. In the short term, however, we anticipate that EPS growth will be quite flat for a few of the trusts, particularly the ones that has higher gearing or low hedging profile or higher debt costs. And we really prefer REITs that has a strong balance sheet and adopting a very sort of capital light models. Looking at interest rates and the impact that has on the REIT sector. So it has, it impacts on both the short end and the long end of the yield curve. On the short end, it affects earnings, and this is rightly so, because the debt cost has risen sharply from about 2% at the end of last year to now as high as 5% for a lot of the REITs. Now, with this, the team and I have done a lot of work looking at not only the LVRs of each of the REITs, but also the hedging profile and the cost of debt of each of the REITs. Now we take this one step further and we look at the interest cover of the REITs, and as a rule of thumb, we will not invest in a REIT that has an ICR of less than 3 times. In the long term, long end of the yield curve, it affects valuation. And however, we think that currently where the pricing is, the market is pricing in 100 to 150 basis points of cap rate expansion. Now, to put it in another way, that means that's equivalent to about 20% of devaluation. And we think that is too bullish, too bearish for the market. As I said earlier, we assumed in our valuation that for office, there's cap rate expansion of 50 basis points. For retail, 30 basis points. And the valuation for industrials is actually flat. And then the sector that we really like is the alternative sectors. And we think that because of the secular trend and because the demand still exists for those assets with its reliable income, we think that there's still going to be cap rate compression for those assets. And in terms of our DCF valuation, we apply a very conservative risk-free rate of 4%, which is about 100 basis points higher than where the market is. Turning to inflation. Now, after a decade of low inflation and very accommodative monetary policies, we are heading to a period of high inflation, which started off as an energy shock and now broadens out to the service sector, which we think is a bit more stickier than what we've seen in the past. Now, in an environment where we have a higher inflation rate, we look at REITs that will benefit from it, and the ones that will benefit from high inflation are the ones that usually has their rents that's tied to CPI. For example, the retail sector, its rental structure is usually CPI plus 2%, or ones that has a high turnover rents, such as the convenience retailers, or the ones that has shorter leases to capture that that re-rating in the rents, and that includes storage. We also look at the ones that have high pricing power. These are the ones that can pass on the higher costs to the end user, and that's usually for us at the moment is the industrial REITs, whereby it's trading at very favorable fundamentals with very low vacancy rates of less than 1% for Sydney and Melbourne, and strong demands, particularly coming from e-commerce. And then for alternative assets, such as childcare, healthcare and retirement living and data centers, I mean, these assets are considered to be necessities and are much less cyclical when you compare that to your traditional office, retail and industrial assets. And looking at how we're positioned, the fund has about 21% exposed to industrials, 24% exposed to alternative sector, and 13% exposed to convenience retail. And the fund does not have any exposure to the discretionary retail, which we think that going forward might be under pressure. Now, turning to valuations, we think that the sector is looking very attractive at the moment. Since the beginning of the year, the sector has fallen about 21% compared to the broader equities market, which has only fallen by 5%. Why do we think that the sector is attractive? It's trading at an average of about 20% discount to our NAVs, net asset values. On average, if you exclude Goodman and Charter Hall, the sector is trading at an 18% discount to NTA. And then in terms of where earnings are, on a PE basis, the sector is trading at a 15 time. Now that compared to where it was trading at the beginning of the year, which is at 18 times. So there's a huge de-rating of the sector. And with that, we think that the sector is delivering very high sustainable dividend yield of 5% with stable earnings of 4%. So at a total return basis, you're looking at close to 10% with very, very attractive valuations. So turning to the next slide, looking at how we're positioned in the past 6 months. I note that it has been a challenging period but we believe that the opportunities at this point in the cycle is with the fund managers exhibiting, really a steady cash flow and having a good track record in growing FUM, such as your Charter Hall, your Centuria Group, and your Goodman Group. And out of that, we have about 14% of the fund exposed to the fund managers. And also, we think that the logistics sector is having fantastic earnings growth. When you look at Goodman, they're still anticipating that earnings growth of about 15% going forward. So that's the growth bucket, and we balance this out by having a more defensive bucket, which includes the convenience retail, anchored by your Coles and Woolies, and also the alternative sector, which includes your healthcare, childcare, and your retirement sector. So this is our top 5 holdings, and with that, I'm going to hand it over to you, Adam, to go through the question and answers.
We have received a few questions. I'm going to try and group them as much as possible. And I'll start with some questions about the strategy and the environment. The first question, it has probably been answered a little bit, Amy, through your general comments, but I think it's a key question, so I'm going to ask it anyway. Yep. What is the case for investing in REITs when there is so much interest rate uncertainty?
Yeah, look, that's a valid question, considering how much interest rates have risen since the beginning of the year. Look, we don't claim to be economists, and we don't know where rates is going to land. But based on the 2 rate hikes from the RBA of 25 basis points instead of the anticipated 50 basis points, this really signals to us that it's at an inflection point, and the RBA is willing to slow down the rate hike. So with that, I think that as we move forward, with rates being a little bit more stable, we think that REITs should outperform, particularly the ones that have been oversold, and that's really including the fund managers that we hold.
And just as a follow-up, does that investment case change if the economy slows drastically or tips into a recession?
Look, I think that relatively, I think that it depends on the subsectors. For office, which is office and retail, which is a lot more sort of cyclical sectors, that might slow down for office and your discretionary retail sort of subsectors. But I think that the ones that we prefer, which is for retail, the discretionary retail, the convenience retail, which is more your defensive retail, is going to continue to perform relatively well, because people have got, at the end of the day, people have got to eat. And then on the other side, we have quite a big exposure to the alternative sector, which is driven by secular trend, and these assets are considered to be essential services, your healthcare, your childcare, and we think that that will continue to outperform.
Great, thank you. Next question. What's appealing about active management when the index is already so concentrated?
Yeah, I get asked this question a lot. Yes, the sector is highly concentrated. It's only got 30 stocks. And it's, with the top 8 making more than 80% of the index, and very heavily weighted towards retail as well. And that is why when I looked to set up this fund, I made it to be a high conviction strategy, because you've got to look outside of the index, and for us, there's a lot of opportunities that's emerging in the healthcare, childcare, and data center sector, and when we look at what the more matured markets like in the US and the UK, where that's heading, I mean, they've got a very large exposure to alternative assets, and I think that Australia will follow suit. So we think that, yes, the sector is highly concentrated, but with our strategy, with our mandate being able to invest outside of the index, still provides that opportunity for growth. And just to refresh a lot of you guys' memory, is that our universe has actually got about 50 stocks when you compare that to the index of about 30.
Makes sense, thank you. But I'm trying to think how best to phrase this. How would you respond to those who are still cynical and point to the fact that you have underperformed over the last year?
Yeah, yes, we have, and that's mainly driven by the sharp rise in interest rates. When we look at our performance attribution, the underperformance is mainly driven by, in the last year, is mainly driven by our exposure in the fund managers, such as your Charter Hall and your Centura Group. We think that as the bond rates sort of stabilizes from here, we think that these fund managers will recover from where it is. Now, let me go a few steps back here. At the current pricing, I'll give you an example of Charter Hall. Current pricing, it's trading at 12 times, right? PE of 12 times. Compare that to beginning of the year, it was trading at 18 times. So there's a huge de-rating. Current pricing, the market is assuming that 0 acquisitions going forward, 0 performance fees going forward, and 0 development fees going forward. Now, the last reporting season, Charter Hall was able to achieve one of the highest performance fees of 330 million. Now we incorporated that going forward. They're not going to be able to maintain that level of performance fees, but we think that they're able to at least maintain half of that performance fee going forward. And then when you look at acquisitions, they've already done about 4 billion of acquisitions this year. So we are very confident in their business model going forward. And we think that they are the ones who will be re-rated once interest rate stabilizes from here. And then, when you look at, this is a long-term strategy, and when you look at our since inception number, which is coming up to 3 years now, we've significantly outperformed the index.
I think that's a key point in this sort of environment. There is always a risk of becoming very short-sighted. Yep. Next question, why the focus on ESG? You made the point that your ESG research impacts valuations, but is the primary driver to cater for the preferences of your investors, or do you believe that it actually does reduce risk or enhance returns?
I would say all of the above. I think that investors are, increasingly looking to invest in strategies that are, more aligned to their beliefs. And then for us as an ESG fund, we use ESG factors in order to manage risk. Let me give you an example, is that as part of our ESG work, we map out all the residential developers that has a high exposure to flood and fire risk. Now, this not only shows how the company managed their climate risk, but it also it's a risk to earnings, because with all this fire and flood risk, it affects, one, their reputation. It causes delays in completions of the projects, and it also affects the end user, the customer, because at the end of the day, they might not be able to get proper insurance for their properties going forward. So for us, focusing on ESG really does impact on reducing risk to the portfolio going forward. And then in terms of returns, I think that over the long term, I think that the assets that has high neighbours ratings, which is that measures the efficiency of the building, will end up performing better, because they're able to attract better quality tenants, and the tenants tend to stay there longer.
So from your portfolio, are you able to provide a specific example of either risk reduction or sort of an increase in returns because of your approach, because of the ESG incorporation?
Yeah, certainly. Like, I'll give you an example. LIC, so Lifestyle Communities, that ranks really, really well in terms of our E and S and G. And when we run through their, exposure to the flood and fire risk, they actually had zero exposure to these zones. So, for them, and on top of other things that they do, initiatives that they do, they rank really well in terms of the E for us. In terms of the S, it's providing, affordable housing for retirees. They do a lot of great work with their with the people around them, doing fundraising, and so also engaging with retirees in educating them on better living, better health. So they rank really well in terms of the S as well. And in G, we think that they are one of the best sort of management of capital. They haven't, since they've been listed, they haven't really raised capital, gone back to the market and raised capital. And so we think that they're able to really manage their capital really, really well. So it ranks really well in terms of E, S, and G, and Lifestyle Communities is one of our best performers.
Great, thank you. Next question, can you explain your preference for capital light models?
Yeah, so similar to LIC, we like ones that are a business that are able to recycle capital, so they don't need to go and try to source debt, increase their debt, or go back to the market and raise equity in order to grow. So that's one example of capital light. Another capital light is, for example, the fund managers, whereby they are able to source capital from their investors. For example, a Charter Hall has several ways of sourcing their capital from the listed market, from wholesale funds, and also from retail funds as well.
And this would naturally sort of lead to a higher ROE is basically the message.
Yes, that's right. And much sort of stronger balance sheet and able to grow in any environment, whether interest rates are going up or down.
Understood. Do you invest at all in global REITs, and any comments about the relative valuations and the opportunity set between AREITS and GREITs?
Yeah, we in our mandate we can invest up to about 10% in GREITs. We in the past we have modeled and analyzed a few of these companies. But given the current market environment, we think that there's risk in going to a market that we're not in our doorsteps, and so therefore, and then on top of that as well, you've got currency risk. So we are monitoring it, but I think having done the work, it gives us a read through to the REITs that we've got, which is mainly Australian REITs. For example, I'll give you an example, is that we recently modelled Prologis, and even before the market have said that there's going to be cap rate expansion, Prologis has come out to say, yes, there's cap rate expansions in the market. And so we use that as a read-through to our exposure in Goodman. So we're able to adjust our models and incorporate that cap rate expansion into our models.
And that is a good segue into Goodman, because we have a question here. Are you concerned about geopolitical risk for Goodman with its exposure to China?
Yeah, look, I think there's always a risk, I think, but I do think that it's quite a relatively small exposure, and it's not like Goodman just have been there for the past 5 years. I mean, these markets, the markets that Goodman are in, they've been there for a long time, building relationships with the current investors, with governments. So therefore, I think that relationship will still be maintained because it benefits both sides. Right. So I think that yes, there is a little bit of risk, but I think that that risk is relatively sort of contained when we analyze everything that drives that stock.
Understood. Next question, can you expand on your underweight thesis for the residential subsector? Are there any parts of the residential sector that you do consider attractive right now?
Yes, we did hold an overweight in residential as of the end of last year. However, when we went through the beginning of this year and we realized that inflation is here to stay, looking at what the Feds, what overseas are doing, that the policymakers are very, very much sort of determined to manage inflation, and we realized that yes, I think that there is risk. We reduce our weighting in the residential developers. However, out of those ones that we hold currently, we really prefer the ones that are sort of more defensive. When I talk about defensive, I mean the ones that are exposed to sort of first home buyers, exposed to sort of a lower sort of price range, and which is a lot more sort of affordable. So not your high range resi developers with high risk, the ones that we like are much more in the range that are affordable, towards the affordable housing market.
Great, thank you. We do have a few more questions, but in the interests of time, I'm only going to ask one more, and the rest we will respond to directly. And I've selected this one, which I like. Can you give us a quick example of a new stock that's been added to the portfolio?
Yes, actually, given the challenges that the traditional core sectors, such as your retail and your office, have been experiencing in the sector, we're really excited that we're able to invest outside of the index and look at new sort of like emerging opportunities, and that stock is Qualitas. Now, Qualitas IPO'd towards the end of last year. It is a real estate fund manager that lends about 60% to residential, and the other 40% is to commercial. The business has been going since 2008 and has extreme good track record in consistent funds under management growth of about 30% plus. And then, with the recent mandate win from ADIA that they got, which is about, I think, something like $1.7 billion, this really indicates to us that they're able to grow their FUM going forward, and also they are getting extreme good traction in their business. So and then on top of that, I think that with the market's concern, and I think going back to one of your questions, with the rise in interest rates, that people don't want to invest in property. Actually, with the rise in interest rates, it benefits Qualitas. Because their fees are based on variable rates. So with that, it's one of the business that we really like. We've met with management several times, and we're very, very comfortable with the strategy and the quality of management.
Amy, thank you. This has been great, and thanks to everybody for joining us this morning. Really, really good questions. So thanks to those who submitted them. As I said, if we didn't respond to your question or a version of your question, we will respond to you directly. Our next webinar in the series is at 9 a.m. this Thursday with John Moog, the portfolio manager of our Global Small Companies Fund. You can register for this on our website, pengana.com. If you have any other questions, please get in touch directly. Thanks again and enjoy your day.